Hello everyone. This would be the final video of chapter 2, tangible non-current assets. So in this video, we would just be covering one topic, that is IAS 40, investment property, and then we'll be solving some MCQ questions. So IAS 40, investment property. Investment property is land or building held to earn rentals of a capital appreciation or both, rather than for use by the entity of a sale in the ordinary course of business. Now, remember while we were studying the definition of IAS 16 property, plant, and equipment, the condition was that that should be used for business purposes. But that is not the case for investment property. Investment property is it is held for rentals, that is, you earn rental income from it, or capital appreciation. It is not used by the entity, it is not used in the business for a day to day basis. It is for rentals or capital appreciation. Owner occupied property is excluded from the definition of investment property. So these properties are not used by the entity in general operation. So as I explained, that it should not be used for day to day business activities, for business operations. These could be spare properties rented out to third parties or specifically brought in order to profit from a gain in value. So as here it says that it can be used to earn rentals of a capital appreciation. So either you earn rentals from it, or you have just bought the property so that you can uh, gain a profit from it when the value increases. That is capital appreciation. There could be a situation where a building can be accounted for in two different ways. If an entity occupies a premises but rents out certain floors to other companies, then the part occupied will be classed as PPE, with the floors rented out as investment property. Now, if a business has purchased a building, the part of the building which is used by the business for its activities will be accounted for as IAS 16, and the floors of the building which has been rented out, that would be accounted as investment property, because it is being used for investment, you're getting rental income from it. So even a building can be accounted for in two different ways based on the purpose. So it's not that one single building will be accounted for in one solo way by using one particular standard. That can also be divided as per the requirement of the building. Now in consolidated accounts, now let's say that if an entity owns a building that is rented out by a subsidiary of the entity, all right, if an entity is owning a building, the parent company is owning a building, and it is being rented out by the subsidiary, then in the books of the entity, that would be recorded as investment property under IAS 40, but in the books of the group, that is in the consolidated financial statements, that would be accounted for as property, plant, and equipment under IAS 16. That is because, so the entity and the subsidiary together form a group. So as a group, it is a property that is being used by the group. So then it is something which is used by that business. So that would be under IAS 16. But in the individual books of the entity, that is the parent company, it would be accounted for as subsidiary. It would be accounted for as investment property, because the entity or the parent company has rented it out to the subsidiary. So in the books of the entity individually, that is an investment property. But in the books of the group, that is consolidated financial statement, it would be IAS 16 property, plant, and equipment. Now, the accounting treatment. So again, investment property, initially it is measured at cost, and subsequently it can be measured using cost model or fair value model. All right. Cost model is pretty simple. It's the same way like how it is being accounted for in IAS 16, what we had studied in the first video. The same process. In fair value model, this is also similar to revaluation, just slight differences there. Uh, so in fair value model, you will value the property every year, at the end of every year, you would value the property to fair value. Whatever would be the gain or the loss, that would be recorded in SOPL, not OCI. Remember that in IAS 16, property, plant, and equipment, the revaluation gain or loss was recorded in OCI. But in case of investment property, that would be recorded in SOPL. So this is one difference. And another difference is that no depreciation is charged in this model. No depreciation is charged. So fair value, and what is fair value? Fair value is normally the, in simple words, the market value. That is the current price of it in the market. So fair value is normally established by reference to current prices on an active market for properties in the same location and condition. A fair value is simply the market value. Alright, so there are two models, cost model, fair value model. So initially you have to always record it at cost. Subsequently, you can continue the cost model or you can adopt the fair value model. Fair value model, revalue the property each at the end of each year, record the gain or loss in SOPL, and no depreciation is charged. Now, we would solve this example, but before that, let's quickly read this. Now, sometimes you might transfer an asset from PPE to investment property or vice versa. Now, let's say that you're transferring a property from IAS 16 to IAS 40. That is investment property. And in investment, for the investment property, you're valuing at fair value, valuing it using fair value model. Now in this case, first you would revalue the asset. You would see, currently it is, as per IAS 16, currently it is a PP. So you would revalue the property using the revaluation model in IAS 16. So basically you would revalue the property, okay, then record the gain or loss in OCI, that is revaluation surplus in equity. Alright, and then after you have revalued it, then you would transfer it to IAS 40 at fair value. Okay, then transfer to IAS 40 as investment property. If it's the other way around, that first it was IAS, first it was an investment property and then it has been classified as IAS 16, and if fair value model was used for recording the investment property, so first you would revalue the property. Okay, you would revalue the property, record the gain or loss in SOPL. Remember, in SOPL, not in OCI. And then you would transfer to IAS 16 at fair value. Here also it would be at fair value. Alright, so if you're transferring from PPE to investment property, first you have to and if the fair value model is used for the investment property, then first revalue the property, transfer the gain or loss in OCI, because currently it is an investment property, currently it is a property, plant and equipment, and any gain or loss on property, plant and equipment is recorded in OCI. So that's why you will record it in OCI and then transfer it to investment property at the fair value. And in case of, and if it's a reverse case, that you're transferring an investment property to a property, plant and equipment, and if the fair value model is used for the investment property, then first you would revalue the property. Now because it is currently an investment property, you would record the gain or loss on the revaluation in SOPL, not in OCI, and then you would transfer it to IAS 16 at fair value. Now this was the case if fair value was, if the property was measured using fair value, but if it's measured using cost model, then that's very simple. You would just transfer the property from IAS 16 to IAS 40 at its carrying amount. Okay, transfer at carrying amount. There is no complex treatment here, just transfer it at carrying amount. And similarly, if it's a reverse case, that is, if you're transferring um, from investment property to property, plant, and equipment, again you would transfer it at carrying amount. So if it's from IAS 40 cost model to IAS 16, again transfer at carrying amount. Okay, this is pretty straightforward. Now let's just quickly read through it as well. If an asset is transferred from PPE to investment property and fair value model is used for investment property, that is, they are talking about this case. From IAS 16 to IAS 14, fair value model is used. The asset must first be revalued as per IAS 16, creating a revaluation surplus in equity, and then transferred into investment property at fair value. So first revalue it, transfer the gain or loss in OCI, and then you have to record it in IAS 40 at the fair value. If the cost model is used, then the asset is transferred into investment property at current carrying amount and continues to be depreciated. Nothing complex. Now, if it's transferred from PPE to from investment property, it has been transferred to PPE, then revalue the property as per IAS 40, taking the gain or loss in SOPL, and then transfer to property, plant, and equipment at fair value. The cost model is used for investment properties. Then the asset is transferred to PPE at the current carrying amount and continues to be depreciated. Alright. So this is all about investment property, nothing complex at all. Yep. So in short, if I give a quick brief, investment property is the property that is used either for rental or capital appreciation. Alright. It can be recorded using cost model or fair value model. In cost model is the same as IAS 16 cost model. Fair value model is that you have to revalue the property to fair value at the end of every year. The gain or loss is transferred to SOPL and the asset is not depreciated. And if the asset is transferred from IAS 16 to investment property or from investment property to IAS 16, then this method is followed. Alright, just remember that what model is used. If fair value model is followed, then this would be the case. If cost model is followed, then this would be the case. That's it. Now let us solve test your understanding 18. Let me just close this. Alright. So Celine, a manufacturing entity, purchases a property for 1 million on 1st Jan 20x1 for its investment potential. The land element of the cost is believed to be 400,000 and the building element is expected to have a useful life of 50 years. At 31st December 20x1, local property indices suggest that the fair value of the property has risen to 1.1 million. Show how the property would be presented in the financial statements as of 31st December 20x1 if Celine adopts cost model, fair value model. Now, the cost of the property is 1 million. In that, land element is 400,000. So obviously the building element would be 600,000 because the total value is 1 million. Alright. Now cost model is adopted. So in cost model, we have to calculate the carrying amount. Now the land element would remain the same because land is not appreciated. So land element would remain the same to be 400,000. Now the building element, the useful life is for 50 years. So depreciation would be 600,000 divided by 50. This comes to 12,000. So the depreciation on building is 12,000. So in SOPL you would record depreciation of 12,000, and in SOFP you would record the total value of the property. Total value of the property would be 400,000 worth of land plus 600,000 worth of building minus 12,000 depreciation on building. So 400,000 is the value of the land, and the value of the building would be cost minus depreciation. So this would come to 988,000. All right, this is the cost model. Now in fair value model, you have to revalue the property to fair value at the end of the year. So at the start of the year it was 1 million. At the end of the year it is 1.1 million. So revalue the property to 1.1 million. Okay, so which means there would be a gain of 0.1 million, right? Now this gain, because it's an investment, it is investment property and you're recording it at fair value. So remember that in case of investment property, in fair value model, the gain or loss is recorded in SOPL, not in OCI. So in SOPL, you would record a gain of 0.1 million, and in SOFP, you would record the property at 1.1 million. That is on which you revalued it, and no depreciation is charged in fair value model. Remember, the asset is revalued to fair value at the end of each year. So we revalued it to 1.1 million. The gain or loss is shown directly in SOPL. So 0.1 million is shown in SOPL, and no depreciation is charged on the asset. So in SOPL you would only record the gain and not depreciation, and in SOFP you have to simply record the property at 1.1 million, that is its fair value. Right? This was pretty straightforward question. Now let us solve test your understanding 9 as well. So the question says that Kylie company purchased an investment property some years ago and carries it under fair value model. At first Jan 20x1, the property had a fair value in Kylie company's financial statements of $12 million, and this is at 1st Jan. On 1st July 20x1, Kylie company decided to move into the property and use it for its own business. At this state, the asset had a fair value of 14 million and a remaining useful life of 14 years. What amount should be recorded in Kylie company's SOPL for the year ended 31st December 20x1? Now, firstly, the asset is being transferred from investment property to property, plant and equipment, because Kylie had purchased investment property, but then it transferred it to PPE because it is being used for its own business. So this is the case of transfer from IAS 40 fair value model to IAS 16, because it's mentioned here that investment property and carries it under fair value model. So it has been transferred from IAS 40 investment property to IAS 16 property, plant and equipment. On 1st Jan, on Jan 1, it has been valued at 12 million. Alright. On July 1, it has been valued at 14 million. Alright. And on July 1, it has been transferred to PP. So the standard says that when you're transferring from IAS 40 to IAS 60, first revalue the property and transfer the gain or loss in SOPL. So the revaluation gain here is, it was initially 12 million, revalued it to 14 million. So there's a gain of 2 million, and this would be recorded in SOPL because you're transferring from IAS 40. So in IAS 40, the gain is recorded in SOPL. Now you've transferred it to IAS 16. Now in IAS 16, you would transfer it at 14 million. But this is at July 1st. We need to find out what is your what would be recorded in SOPL by 31st December. So on July 1st, it has been transferred to IAS 16. You would need to charge depreciation for the remaining ones. So depreciation for the remaining 6 months would be, so now on July 1st, it has been valued at 14 million and now it is IAS 16. The question says that it has a remaining useful life of 14 years. So 14 million cost divided by 14 years would give you depreciation of 1 million per year. But we only need for 6 months from July to December. So depreciation for 6 months would be just 0.5 million. Alright. So finally in SOPL you would record a gain of 2 million and depreciation of 0.5 million. So net would be 1.5 million in SOPL. This is how it would be recorded. Now there are some MCQ questions. I would be solving a few of them, and a few of them you would be doing it as part of your studies. So let's begin. An entity purchased a property 15 years ago at a cost of 100,000 and have been depreciating it at a rate of 2% per annum on straight line basis. The entity have had the property professionally revalued at 500,000. What is the revaluation surplus? Now, so it was purchased 15 years ago. So revaluation surplus is the revalued amount minus the carrying amount. So first we need to find what is the carrying amount. The cost was 100,000 and it has been depreciated for 15 years. First, let's calculate what is the depreciation per year. Depreciation per year would be 100,000 into 2%. 100,000 into 2%, and this would be 2,000. Alright, it has been depreciated 15 years. So depreciation for 15 years, 15 years of depreciation would mean 2,000 into 15, which would be 30,000. So its current or carrying amount would be cost minus depreciation, which is 70,000. So revaluation gain would be 500,000 minus 70,000, which is 4,30,000. This is the revaluation gain. Alright. Next question. An entity owns two buildings A and B, which are currently recorded in the books at carrying amounts of 1,70,000 and 30,000 respectively. Both buildings have recently been valued at so and so. The entity currently has a balance on revaluation surplus of 50,000 which arose when building A was revalued, right? Building B has not previously been revalued. What double entry will need to be made to record the revaluations of buildings A and B? Firstly, let's calculate what is the revaluation gain or loss. So, building A, revaluation amount is 400,000 and the carrying amount is 170,000. So the gain is 2,30,000. Whereas for building B, the revaluation amount is 2,50,000 and the carrying amount is 3,30,000. So the carrying amount is 3,30,000. It has been revalued to 2,50,000. So obviously this is a loss. This is a revaluation loss of 80,000. Alright. Now remember that these are both items of PPE. Alright. Now in PPE, the revaluation gain is recorded in OCI and the revaluation loss is recorded in SOPL. Now the revaluation loss, there is a revaluation surplus of 50,000, but it is in respect of building A only. If it was in case of building B, then we would have been able to set off this 80,000 loss and then record only the net value. But since the revaluation surplus is not for building B, it is only for building A, we would have to record this full 80,000 in SOPL. So this 80,000 is recorded in SOPL. Gain of 2,30,000, this would be recorded in OCI. Alright. Now it's pretty straightforward from the option. There's only one option where 80,000 is recorded in SOPL. So 80,000 recorded in SOPL, OCI recorded 2,30,000, and then 1,50,000 would be recorded in non-current assets. Let's solve a few more questions. On 1st April 20x0, Slow and Steady Company held non-current assets that cost 3,12,000 and accumulated depreciation of 66,000. During the year ended 31st March 20x1, Slow and Steady Company disposed of non-current assets which had originally cost 28,000 and had a carrying amount of 11,200. Slow and Steady's company policies to charge depreciation of 40% on the reducing balance basis with no depreciation charged in the year of disposal. What is the depreciation charged to the statement of profit and loss for year ended 31st March 20x1? Now, let's do this question. So, the cost is 3,12,000 and the depreciation is 66,000. So which means the carrying amount at April 1, 20x0 is 3,12,000 minus 66, which is 2,46,000 is the carrying amount. Now, the question says that 11,200 is the carrying amount of the asset which is being disposed. So 11,200 is the carrying amount which is of the asset being disposed. That means the remaining carrying amount of the other part of the asset would be total carrying amount minus the carrying amount which is being disposed. And the question says that no depreciation is charged for the asset in the year of disposal. That means no depreciation would be charged on 11,200. But we would need to find what is the depreciation on the remaining part of the asset. So carrying amount minus depreciation, which is this multiplied by 40%. So 93,920 is a depreciation that would be charged. And if you want to know the carrying amount at the end of the year, it would be this minus this. All right. So we know that the cost at April 1, 20x0 was 3,12,000. Depreciation was 66. So the carrying amount at the beginning of the year was 2,46,000. In normal scenario, if no asset was being disposed, we would simply calculate the carrying amount. We would simply calculate depreciation on 2,46,000 and get the carrying amount. But since a part of the asset is being disposed, that is 11,200 is being disposed, we need to calculate carrying amount only on the remaining value, which is 2,34,800. So on 2,34,800, we calculate the carrying amount, we calculate the depreciation of 93,920. So this is the depreciation that would be charged at the year end. Right? Next question. A building contractor decides to construct an office building to be occupied by his or her own staff. Tangible non-current assets initially measured at cost. Which two of the following expenses incurred by the building contractor cannot be included? Cannot be included as part of cost of the office building. Okay. Interest incurred on specific loan taken out to pay. This is borrowing cost, so this will be included. Direct building labor cost, again direct costs included. Proportion of contractors general administration cost. This is general administration cost. Administration cost is not something that has been included. Remember, training costs and all of that is not included. So this is one of the option. Hire of plant and machinery for use on the office building site. Yes, because it is being used on that, so it's included. Additional design work caused by initial design errors. It is caused due to error. It is not really part of the asset. It is expenses which happened, like extra expenses which were incurred, like wastage. So this can't be capitalized. Then delivery costs in getting the raw materials. Yes, transportation costs can be included. So the options are C and E. Now, last question that I'll be solving. The purpose of depreciation is to allocate the cost less residual value in a systematic basis of asset useful life. This is the option. Write the asset down to its realizable value each period. No. Accumulate a fund for asset replacement. No. Recognize that assets lose value over time. No. So the best suitable is the first one. Now with that, I've completed chapter 2. So in this chapter, we learned about IAS 16, government grants, borrowing costs, revaluation, investment property, and we also practice some MCQs. So this is all from my side for chapter 2. In the further videos, we would be studying the other chapters as well. Thank you so much.